Nature has a formula. It uses it wherever it can. You would be surprised to find that nature behaves in cycle. And share market being the biggest replica of nature, the beautiful chaos it has follows the same. It has meaning and structure to every move it makes. Though it may look very confusing at first, but when you start seeing things, that's when you unsee it. The bigger picture gets revealed. By now, if you are wondering what cycles are, what trend lines are, that's exactly what we will try to explore in this video. We will see what trends are, how they are formed, how they move in cycles, and the endless fractals. Then we will see the trend types, the market structure. In market structure, we will again scratch what Dow theory is, then Wyckoff price logic, and Elliott wave theory is. Once we understand this, we will see how to draw and interpret trend lines. The purpose of trend lines, price behavior at trend lines, what the heck is support, resistance, and channel, what's mean reversion, static and dynamic trend lines, designing trading strategies using the knowledge we had gained. Basically, any trading strategy we see in market is either trend following or trend predicting. We will explore what they are. Designing trading strategy is also excessively big concept. It involves lots of data, backtesting. I will try to make a different video of how to get data, backtest it, and find the edge our design trading system has. But for now, let us stick to this concept. We can design our own strategy using the knowledge gained in this video series. Then some actions in chart. With no further ado, let's dive right in. What is trend? Trend is basically a fad or fashion style. It's a tendency. For example, after COVID, masks were in trend. Before that, no one bothered. I didn't even knew this existed. Not only mask. How many of us remember Dalgona coffee? That's a classic example of a short-lived trend. There are other trends like movies, OTT, web series, you name it. Do you guys remember using Orkut? The yesteryear's social media? Hi-Fi, Pinterest, Twitter, Facebook, TikTok, now Instagram. You see, we had been shifting and using different platforms as per trend. Yes, the word is trend here. To keep us hooked to the platform, they use the hook model. That's another study to explore in fundamental analysis of platform businesses. We'll do it in some other video in future. We now understand what trends are. Let's see how trends are formed. For any trend, there are 4 key stages. Stage 1 is question mark. This is where the development happens. Then gradually it's exposed or introduced to the early adopters. Stage 2 is star. Here is where it gains momentum. The early majority picks it up from here. Stage 3 is cash cow. Here is where the late majority picks up. Here is where the trend gets matured. And you see almost everyone are using or talking about it. Discount. Stage 4 is cash dog. The laggards come here. The trend is usually vanished or is already extinct. The complete process is one cycle. When there are cycle inside a cycle, that's called fractals. Probably if you are wondering, Inception's dream inside a dream inside a dream. That's a small example of fractals. We see it daily, it's around us. The whole universe, world, nature, everything is built on it. The maths part of it is called Fibonacci series. Have explored, or you may say have scratched the surface of it in the price action mastery video. Let's see some cycles market follow. First is Dow theory. There are 6 main components to the Dow theory. First is market discounts everything. Second is there are 3 primary kinds of market trends. Third is primary trends have 3 phases. Fourth, indices must conform each other. Fifth, volume must conform the trend. Sixth, trends persist until a clear reversal occurs. We shall explore Dow theory in much detail in some other video at some other point of time. The current takeaway for this video should be, in markets there are 3 types of trends: uptrend, downtrend, sideways trend. Now to draw trend lines, we identified 2 swing lows and draw a line connecting them both. The line is expected to act as a support. What is support? Support generally means giving assistance to. When you are down or sick, someone supports you. That exactly happens when the market falls. The trend line we draw acts as a support to the price. And when we do the same by connecting the swing highs, we get resistance. Resistance means the refusal to accept something. You can't go ahead of it. When the market thinks the price is higher, they push it down. The point from which they do that is resistance. Channels. When price orbits around particular support and resistance, they are called channels. Price is between support and resistance, so this channel is made. Same is the case in downtrend, where we connect 2 lower highs and draw a line to get resistance, and connect 2 lower lows to get support. When we see this in charts, we will be amazed how market respects this theory. When market breaks supports, it's called breakdown. When market breaks resistance, it's called breakout. Let us see the next cycle, Wyckoff price cycle. Like we saw earlier, the whole world moves in cycle. Likewise, markets, a particular stock also moves in cycle. According to Wyckoff's price cycle, market has 4 stages. Stage 1 is accumulation. This is where the big players accumulate the shares of the company. This stage is also called basing, where the smart money gets in. Stage 2 is advance. Here is where the price gives breakout. The price comes out of the range and goes higher and higher. That is a star now. Stage 3 is distribution. This is where the smart money exits, offloads the share they had accumulated to the retail participants. And we, the retail participants, as usual, get euphoric and buy it. Stage 4 is decline. The cycle repeats again and again. Accumulation, advance, distribution and decline happens again and again. Retailers' money goes to big players. Big players make money, retailers get trapped. The next cycle we would discuss would be Elliott wave. The Elliott wave theory looks for recurrent long-time price pattern related to persistent change in investor sentiment and psychology. This theory identifies impulse waves and corrective waves. Impulsive waves that set up the pattern, corrective waves that opposes the large trend. Not all, but almost all major pattern formation in markets are a variance or a part of Elliott wave. Patterns is yet another very interesting topic which requires a lot of detailing to it. We shall explore that on some other video. Before getting into building trading strategies, let's see what is trend following and trend predicting systems. Probably any strategies we come across, it's either trend following or trend predicting strategies. Trend following is following the trend. Trend predicting is being prepared before the trend establishes. Let's see this with the example of wildlife. When the cheetah goes to prey, it runs behind the prey to catch it. Running behind basically is called trend following. You are following something. But have you ever noticed how the crocodile hunts? It waits for its prey in the riverbed and seizes the right moment. This is trend predicting. We saw market structures. We know what trend is. We know what cycle, support, resistance, channel is. We know what trend following and trend predicting system are. Let's explore this in live chart for better understanding. Due to time constraints, we should end this video and do the second part of this.